Okay, so there's always the acid test. Are you seeing what you need to see, Ignacio and Josh?
Looking great, Dan.
Looking
Thanks.
great, yeah.
Okay, good. Well, we'll proceed. I appreciate your Chad, your thoughts about the uncertainty in a year like this. And without question, we've had the markets absorb news that in hindsight, yeah, there were some issues that we could have perhaps anticipated when we saw last year the Chinese corn futures jump so high, but still we were unsure how that was going to affect us. Um, uh, Egged on somewhat by some lingering crop production problems in South America, um, and I think the emergence of an urgency on the part of buyers to secure corn supplies, all those came well, and that third element followed from the first two. We shifted from pretty much a seller's market at 350 to 360 or 370 to a buyer's market at, well, we'll look at where those prices are at. Excuse me, I said that backwards. We're in a seller's market right now. If you have unsold grain, unsold corn, you're in the catbird seat. Whereas before it was a buyer's market. Let's take a look at some of these factors. Okay. All right. Okay. Um, so what? So really, what to anticipate this year? What news is coming at us that will affect the market that at least we can anticipate? Um, I think the big factor right now to look forward to for this coming year will be what are farmers' expectations of profitability and how will that translate into their spring plantings? Uh, I think there's still some time now to see what happens in South America for the size of their crops. So they have a first crop of corn and a second crop of corn, and what happens, and the first, as Ignacio and I were talking about before all this started, there were some hurdles for that first crop in Brazil in particular, and some ongoing issues in Argentina that have hindered that crop from being all that it can. The second crop corn is coming on. You still have some dry areas that at least border on the critical second crop areas. But so we first need to determine what the South American crops will be. And once we get to that, then we come up on new information. You'll see here in a couple weeks the USDA will come out with their projection for of planted acres for 2021. It'd be at their Outlook conference, and the USDA on some things they're conservative, on other things they're almost well they're um, almost extreme. Their extremism is that they're always conservative, almost always. What we hear though, in terms of discussion in the market, as people have tried to anticipate this, is that we're looking at somewhere between 2% to 4% higher corn acres to be planted, and really the price factors that'll affect that, I think, will be kind of a horse race between the information we're paying attention to, i.e., exports, and the information that we're paying closest attention to, and then also ethanol. We have weekly data coming out on ethanol. Feed use, we don't get feed use until the quarterly stocks report, so we don't get a confirmation. So already, one date to watch for this year is going to be an important date. The first one will be the March 31st. We'll have a prospective plantings report, and that'll kind of set the first official marker out there for people to either believe or disbelieve in terms of U.S. corn, soybean, sorghum plantings, other crops also. And we'll also get at that report on March 31st a quarterly stocks report, and that'll give us some idea of what feeding is doing. Under the surface, in our part of the world, there seems to be a lot of discussion about wheat feeding going on, and you can see it in the prices in Colby and especially Garden City. So you'll have this happening for corn, but you also have anticipation of where we might go on soybeans. And with soybeans at 13 plus, touching on 14, how do people respond to that? And for this isn't a soybean meeting, but what's shaping up, if those exports continue, is a real Donnybrook of a battle for the rest of this marketing year between whether soybeans go to exports or whether they go to crush. So that's what we're kind of looking at. And in this Kansas, Oklahoma, Texas area, grain sorghum with its tremendous basis, driven exclusively, and I mean that exclusively by China demand, will also likely come in and have some impact on acreage. But the thing that I keep in mind, and again, I'm not belittling sorghum at all. It's an important crop for us here in Kansas and in the U.S. But the just the sheer quantity of exports of grain sorghum, 295 million USDA projected, relative to the exports of corn, 2.6 billion, kind of shows where, well, it shows that in this feed grain complex, gosh, corn's awfully important. Sorghum has this special place because of this gap it has now with Chinese demand, but still the quantity that we're paying most attention to is on the corn side. We come into this year with concerns about dry weather. Pretty cold right now. We're going to get some snow, etc. We had some recently out here in western Kansas, but the latest drought monitor map, as conservative as something like this is, shows that basically the top half of Kansas, half in terms of a diagonal split, all showing signs of dryness, and the farther to the northwest you get, the drier it is. So a lot to be concerned about there. This is supposedly, well, I shouldn't say supposedly, it's a La Nina year. La Nina years can end up and cause crop challenges and problems. I would say when you look at that map, the thing that of course I'm concerned about Kansas, but there's some dry areas all the way up to North Dakota and into Minnesota, et cetera. And that same area of Iowa last year that was dry, if you remember, and in that kind of northern part, northwest part, that we were paying attention to that in Iowa before that Derecho wind came through and did all the damage in the east. But they have the seeds of the same challenging issue there again this next as they had last year. Projections, again, very early, mid-February. Basically, you can see some of the areas that are projected for the next week or so to stay dry. All this is really premature. 1 or 2 rains can undo all of this, or heavy snows, but still, here they are, and it's a factor to consider. I kind of watched this satellite-based source of information from NASA. NASA GRACE comes out of Nebraska, kind of puts this together, and you can see it kind of defines a little bit more that west central Kansas challenge, and you see some pretty concerning areas up in North Dakota as well. Given that exports have been such a driver in this, it makes sense to be looking at what our corn export competitors are doing, or what they have done. In terms of the major countries that we in the U.S. compete against, Brazil, Argentina, and now Ukraine. And the projection of all those together in 2021 is down about 1.3% from 2020, down about the same amount from 2019. The big issue is, and we feel it, is that the production these last 3 years, 19, 20, 21, all up about 29-30% from where it was back in 2013 through 18, aiming at the export market. So that is just the reality of the competitive situation we're in. That's for production. Their exports, interesting to look at their exports. Again, amongst these three, down 3% from 2020, down almost 10% from 2019. But again, they produce that, they raised their production 30-some%, their exports up 50% from that previous 5-6 year period. So clearly countries that are aiming to compete with the US. Argentina, Brazil, up and down in terms of weather. We've had a kind of a good part of a weather market this year, just not in our national boundaries. It's Argentina, Brazil, and they have export taxes that they're dealing with, weak currencies generally, which gives them an advantage in the export mode when their supplies are available. And Ukraine, Russia, again, plus or minus weather. You hear reports of dry conditions. We hear more about this in terms of their wheat crop, but geopolitical conflicts, logistics issues, particularly in wheat market, weak currencies. Again, what's emerged now is domestic food cost inflation, and it's affected wheat, but I haven't heard so much on corn. Perhaps it's happening more so happening there. I just had not hearing about it, but the Vladimir Putin has come up with algorithms to determine how much they'll export for wheat now, and normally that's another market. But with a strong demand for corn, we've got wheat feeding happening both in our country and in these other countries. So big issues to consider. Here in South America, Ignacio, I'll comment on this some, but if you see something here after seeing these slides that you'd like to comment on, just go ahead and hop in. Here's the latest RIT zone moisture drought indicator from that satellite data out of NASA GRACE, and you can see some pretty dry areas in some pretty important parts of Brazil and parts of Argentina, particularly dry way down in the boot down there. But when you go on and when you take a look at what the first season production and the second season production is, and where it's grown at for corn, that you see that Mato Grosso area for the second season, particularly showing up. My understanding is that the second season production has been more their export oriented crop. So when this comes out eventually, then it's a direct competitor with what it'd be our old crop. Comes in generally a bit ahead of that than we come in the fall when we have our supplies. So their gap is ahead of that. So you can see that and take a look back at this map. Some of those dry areas in Brazil look fairly close to where that second season corn thing is. It's like where they grow their second season of corn. I wanted to add this in here too. And why are we talking about soybeans? Well, soybeans, new crop, soybeans and corn are in they've got this jousting match going for bidding for acres. So if to the degree soybeans get worried about their supplies, Mato Grosso and these other key areas, it comes back and affects the Dees corn. Argentina, you can see where this is at relative to the weather situation. Again, I kind of keep in mind where this is, see where Uruguay is at, and you can see that weather map. And a lot of the Argentine area, the key areas, seem to be a little bit better shape, relative to what seems to be dry, except maybe on the west than what we see otherwise. Ignacio, would you like from your home contacts, what are your thoughts when you see this map? And are my concerns valid?
Yes, Dan. I mean, it's exactly what we were discussing at the beginning, right? I mean, if you look at the down section of the west side of the province on Buenos Aires, I mean, that is the south, boot section there in South America, in Argentina, and then the central part is really being affected. I mentioned that based on the contacts, it looks like the effect is more on the first crop, but not so much on the second one. So, but the first crop is also a big one. So I think that we'll be seeing some effects for sure.
Well, this their balance, their supply demand balances will affect the strength or the enduring strength of our exports. To the degree they're short and want to hold on to supplies, that comes back and enhances the willingness of other countries to come in and buy from us here in the United States. Let's kind of move on then to kind of keeping that a couple of those bigger factors in mind. Take a look at corn markets. So I think in trying to distill out the most important factors that we watch, we basically watch corn stocks to use, and try and look at how stocks to use, the tightness of supplies or lack thereof, have been associated with prices in the past. So here, generally, we're seeing strong corn prices because of tight stock situation. Ending stocks came out of this February 9th report earlier this week at 1.502 billion bushels, down from 1.9 some year before. The market, there are people in this market, a fair number of them commercial concerns, that were disappointed that the USDA did not lower that number down. It was lowered 50 million bushels. There's discussion of, I think the projected amount coming into that report was something like 1.4, and discussion 1.25. So the market generally thinks that the US, if they're still thinking this, thinking the USDA is being too conservative in the adjustments that it made. Basically, they raised exports 50 million bushels, and you do the math, and they're probably expecting 100 or more million bushels of exports, and that's reflected here. Stocks to use 10.3, down about 3.5, 3.4 from the year before, and let's say that those market watchers are right, and we end up at 1.4 billion bushels, or 1.35. Well, then we're below 10% stocks to use. We're putting ourselves into these supply-demand relationship curves in terms of price responsiveness, that where you start to respond even more readily than we are. And I think what's happening in the futures is the anticipation, basically, of that happening. 10.3% is pretty strong, but as you jump higher than that, if stocks use goes lower, then this 430 probably has to move higher. Now, this season average price has already got September through January factored into the season average price calculation. It's kind of a weighted average of marketings times monthly prices. So it's going to take a lot to move this, but for what's left of this marketing year, this number could still move quite a bit if, and this is the cash price number, not the futures. Could move quite a bit if we see a lot more exports coming. I just want to hit on some key points here. Corn futures, this is the weekly chart, and you can see, Chad, just as you were talking about, wow, what movement and volatility, and it's all been for sellers positive volatility. And I think the key thing to keep in mind is, we're trying to balance supply demand, is that this is volatility on the buyers side too. So I had this ongoing concern about how the ethanol industry, how the livestock feeding industry are all keeping up on this basically export driven price run up. And you can see we're back on April 17th of last year, we were at 325, and now we're about $2.50 higher than that, based on largely Chinese floods the year before, diseases, and now trying to catch up. So you kind of see this is from January 16th to January 2016 to the present. And again, closed today at 541. That's on the March contract. And here you got the same similar chart, a monthly chart going back to 2005. So when you see the end of 2006 and that jump that occurred there, just a little bit to the left of the 2007 deal, that was when ethanol kicked in, and you can see what that had done to this price plane, the plane of prices that we're operating in. Now when we're low, we're hanging around $3. Before, when we were low, we were hanging around about 2 to 225. So with all the run up we've had, we still aren't in the ballpark. Well, we're basically a little more well, we're about a third of the way, 40%. We've got 40% left to get up to the highs of what we had in 2011, 12, and 13. Ethanol and drought together, and wow. So anyway, I've got some thoughts on the long-term good or not good of that, but if you want to ask later, we'll talk about it. I want to take a little more of a surgeon's view of futures. And the only problem with this is by the time you get into this, you take up all your time doing it. Here's the March contract on today's close, 541, up about 6.5, and then May and July, no carry, but you know, kind of falling off some. Basically, they're anticipating South American crops coming, but not in a major way. That's just kind of a curtsy to it. But look at the volume. We're basically a first week of March, and in watching that contract volume and open interest, contract volume is up, but there's more open interest in terms of both contracts and bushels, and no small amount of bushels. I mean, gosh, 5, 6, 8, 7, 8 billion bushels by the time you add up just what they have there, worth of contract positions. And what's happened even since Friday was that you see the open interest in the March contract rolling over, well, diminishing. And if a lot of those contracts were longs, well, that kind of explains some of the weakness we'd seen the last day or so as people were rolling out of March into May. And again, so that you see that May contract, 2.9, almost 3 billion bushels worth of positions in the May contract. It is interesting to see how many folks have ventured out to do any forward pricing, and not that many. 1.6 billion bushels worth, and that's at 452. One other thing to keep in mind is that 452 is you know, right now we're RMA, Risk Management Agency, is taking the daily closes during the month of February of D's corn futures, D's 21, to figure out their planning price for crop insurance. So it's hard to think that we're not at 445, 455, something like that for a monthly average price. You know, things could change, but a good solid starting price for revenue-based corn crop insurance this year. And don't have a lot of time here. Look at this. Just wanted to show you what traders are thinking. Commercial hedgers, we have, as far as back as I have data, we have record hedging going on. So the users are protecting themselves. And this is just the net position. You see that the blue below the line, record protection of cash position, of what will be cash positions. These are that's the blue lines, the commercial hedgers. The managed money specs, interesting. They're positive, you know, net long, but they have been longer than this before. We'll look at this a little bit more. Here's more on the commercial hedgers. So, you know, ethanol, livestock feeders, all these folks, you know, nearly 6 billion bushels worth of sell positions. And you know, there are people on the buy side of that too, and they're at about 2 billion, but it's the sellers that get your attention. And for the specs, they're in it just to trade the direction where they think things are going. And just thought-provoking to me, we get about 2 billion bushels. That's where we've been before, but kind of hesitant to move much beyond that. I want to show this chart, and then I'm going to move pretty quickly through some things. I want to get down to really kind of a projection of the impact of this acreage decision. So I'll see some things here, but move pretty quick and just kind of allude to them. I think when you look at what the futures are telling us and make some assumptions on basis throughout the market year and see where we've come in this 2020-21 marketing year. So USDA, they're projecting 430 by the time I calculate through that and use again weighting by month, and you look at the futures, make some basis assumptions going forward. I hope they're reasonable ones. You know, project about 434. So I think the USDA's projections are not made in a vacuum away from looking at what the futures are doing. That's just my own thought. But see this run up we've got into February, and they're basically showing some tepidness through March, April, May, June, what futures are showing, and then a drop off into July and August. Now a drought, prolonged strong usage can change all that, but Chad, as you were mentioning, what do we do? Well, for old crop, we've got some great options here. For new crop, that's what I wonder about in terms of forward pricing and what opportunities we would have for movement there. So you can see again from where we're at now, the markers, the futures are they're hand-wringing warriors. They're sort of like university economists, always looking at the downside, but then that price falling off. I think there's been about a 75, 80 cent difference between March and December for a good while now. So they're anticipating acreages will go higher. We won't have a short crop, and that eventually we'll work our way out of this. You see some real basis differentials for corn in Kansas. Garden City, livestock feeding area, some ethanol plants out in there. And you see a basis, last info we have off of Ag Manager, basis about 30, 35 over. Look at Salina, we're about 10, 15 under. So just some real differences by areas of the state in terms of where basis is at. And that blue line coming in from the right, from the left, pardon me, that would be where we're at in 2021 as we move through the weeks, and the red line is where, as it climbed, that's where we ended up at the end of last year. So just a continuation, really, in both of those cases of these price levels. And just you can see this. You look at, and basically this is a KSU calculation using DTN bids on a weekly basis each Wednesday to see what basis is, and the bluer the color is, the stronger the basis, and the redder it is, the weaker the basis is. I wanted to talk a little bit about this. Again, we're paying a lot of attention now to where what people might do with regard to corn versus soybean acres in the United States. On today's closes, you've got the March for the upfront side, March soybeans versus March corn. There's you see a ratio of about 2.53 on the closes, and you can see kind of some of the differentials that you'd see for corn versus beans and different, you have running from Colby, Garden City, Salina, Hutchinson, Topeka. But I'm more thoughtful thinking about the long term. We're wondering where our acreage is going. Well, these the futures are 2.6 advantage soybeans a little bit. Generally about 2.4, 2.5, often where we draw kind of a break even at. 2.6 advantage soybeans. But you look at different areas of the state for corn versus beans. Again, out in the west, Garden City, Colby, you got to really, you're hanging around 2.4. So that's about a break even thing in terms of the new crop. These are new crop bids listed on DTN. I'm taking the highest bid in each community I could find. You go to Central Kansas, Salina, Hutchinson, little higher price. Well, really, basically everything in the eastern 2/3, from the center to the east of the state, pretty much a little bit different situation. Hutchinson about 2.47, but again about 2.58, 2.6, 2.56. Even in Columbus, down there in the corner, Chad, you're showing a little bit of advantage to soybeans, but not a lot. I do want to show this thing here. If wheat feeding is coming in because people they're having a tough time getting corn supplies and not because we didn't grow corn, but because it's so zealously being pursued to be tied up to, for different users, then, you've got a price ratio today in Colby of 1.05, which is long thought to be the break even. At least that's what I was told is kind of a benchmark between for feeding wheat versus corn. Below that, advantage wheat; above that, advantage you'd feed corn. But down in Garden City, they're almost par, almost the same price. So if there's wheat feeding going on, man, there's where you'd see it. And just by what the market is telling us. I would say down here too, you look at sorghum versus corn prices, and yes, we've had pretty strong sorghum prices. Not so much in the southeast part of the state, not as much in the Garden City area. A little more, probably the biggest issue is there around Topeka and parts of east central, northeast Kansas, where you've got in very export oriented market. You've got sorghum prices pretty strong relative to corn. Okay, so Chad, I think, excuse me, Josh, I think we've got about, do I have about 5 minutes, 5:10?
Yeah, keep going, Dan. You're fine. And just a reminder, if anyone has any questions for Dan, go ahead and type them in the Q&A or chat box, and I'll make sure he sees them.
Let's hit on this issue. What's the impact of 2% or 4% more acres on both on production, and really we're after price. That's what we're after. So if we're up 2% in terms of planted acres from 90.8 last year, that'd be about 92.6. If we're up 4%, be 94.5 in essence for corn planted acres. And I've seen, I think there was a Farm Futures survey that came out and said that farmers had told that magazine in this online survey that's what they were going to do, 4% more. And the confirmation probably is that we hear a lot of reports of fertilizer, crop input prices being driven up on kind of a tight squeeze in those markets. So that's, if you were betting those two scenarios, you probably look more at the 4 than the 2. So higher by 2-4%, other could be higher. I'm gonna just take the last 5-year average yield, and it's not 176, it's 173, because you got a couple lower years along with those high years. So I'm going to use 173.4. You assume average, and then you get to this deal: corn production and supplies. So if we get acres up 2%, use a historic multi-year average of harvested to planted, plug in 173, you're at about a 14.7 billion bushel crop. Get 4%, you're at 15 billion bushels. So you wouldn't think that would make a lot of difference in price, but since we're sort of on the cusp of the area where prices start to really react, it's a big thing. Exports, you can see corn exports had been running in the middle of the, and these aren't the purchases, these are the actual shipments. So yeah, we're on a trajectory to end up higher. It'd be interesting to watch here, but on a higher trajectory of actual usage than we've seen in any of these years since, well, 2012-13. The other years I just didn't include, but the highest year coming up that we'd be ahead was 2018-19, but that year tailed off. So we'll see where this one goes. And just want to, you can see these here. Basically, you see ethanol usage having recovered within about 12 to 15% of where we were prior to COVID-19 hitting. But you do see some concerns of ethanol stocks starting to rebuild some, but even that's tailing off a little bit. It is interesting. Ethanol price is about $1.50 and per gallon at plants in the area in Iowa anyway. And boy, we need that to keep up with the higher corn input costs. So you can see this just gives you an example. So this to me is where economists spend way too much time. We sit there and we look at percent stocks to use and look at what U.S. corn prices have been and get some idea maybe of where changes in stocks to use might drive things. So you can see we've already come come quite a ways. We were back in spending our time at around 350, 360 for a good long time. Now we broke out. We're heading towards a higher area, but once it doesn't take that much longer, you get down to 9, down below 10%, where you start to get into a very inelastic, explosive price situation. So we're watching that. And you can see the trend for stocks. It's not just a 1-year thing. It's been stocks and stocks use have been going down for about 3 years now. So this is these next few slides are what I want to show you, and then Josh, I think I'll turn it back over to you, and we can go where questions would take us. So I put together some supply demand scenarios for both old crop and for new crop. So for this has to do with the issue of the question of how do we finish out this year. And I've got scenarios there, and it's small print and all, but there is, again, you can see this. We'll have this presentation up on KSU Ag Manager tomorrow morning that you can come and look at the details of it. But I'm assuming that it's about a 40% chance that the USDA is right. If there are USDA people on here, they'll wonder about that. But there's some things that could happen if what the USDA said for exports is right, 2.6 billion, and the market generally is overestimating things, and higher prices start to choke off usage, some combination of lower ethanol and feed usage down about 75 million bushels, you end up and you see a little bit of a weakening in price by the time we get to the end. Stocks come back up, or 10.86, 10.9 stocks to use. But that's probably, I'm thinking that's only about a 10% chance. What's on the other side of that, though, scenarios 3 and 4, is that, let's say, probably exports probably are underestimated right now by about 150 million bushels. And if exports go up 150 million bushels and it doesn't affect the other uses, then you have scenario 3. And if you matched up that last chart with where 9.15% stocks to use take you, that's 455. But if we get some cutback in usage, and that would happen probably if we really jump that high, you're still at 445. So there you've got, I guess I've laid my cards on the table. I think there's a 50% chance that the USDA will have to raise their projections of prices for this year, because I think that very likely the stocks will tighten up. And you can see that here on this chart. Just another way of looking at it. And here's here would be the last one I'll show Josh, and then turn it over to you. So what about next year? Where does this thing go? So I looked at the 2% scenario and the 4% scenario, and we got see the acres, same yield, and using the USDA's ending stocks projection for this year, 1.502 billion, and plugging in the 14.68 and the 14.96, basically 14.715 in, and you end up with the difference between about 1.5 and a half, 1.6 billion bushels, 10.8% stocks to use, and that's about 420. It's about not far from where we're at, maybe a little lower than this. So 420, but if we get 4%, the same yields, everything goes through, you're up closer to 1.9 billion bushels, and about 12.8% stocks to use, about 370. So Chad, I keep going back to that question you thought out, well, what do we do? Well, that's a great question. But this acreage issue, as it unwinds itself in our crop production this year, as that works from that, I'm showing there, just by historic relationships, about a 50 cent differential on just a moderate increase versus a larger increase. 370 would take us back to where we were for the last several years. So anyway, I think this is what's at stake in terms of what these acres do, and what our expectations might be as we come out of prospective plannings report in end of March. Then there's an acreage report again the end of June, and as the market keeps working its way through all that, we'll eventually get to the reality of it. But you'll have the market with its revealed worry and what it thinks of all this affecting those new crop futures at every step. So it's something to watch. Well, thank you for the opportunity to speak with you. Again, I've got more here that we could show. there's one thing I do want to show you. Okay, we'll go to the very end here. I want to show you this chart. What about China and what about their numbers? Are they right or are they not? Well, there's growing consensus that probably the best number for what China actually has is the USDA number, because I'm not sure China knows. They don't have a functioning NAS like we do, USDA NAS. So, but when you look at how tight supplies are in the world with this big aggregate, with this assumption about what China has in it, then world ending, well, stocks to use to be at the top there. You're looking at 25% stocks to use versus about 10.5 without them. So that bottom line, gosh, no wonder we've got strong corn prices. We've been tightening up on supplies pretty readily. It's not quite as worrisome if you're looking at the aggregate, but again, you got that question, just what is China? And when you get down to the numbers, it's kind of startling. Without China, ending stocks 90 million bushels. 90 million metric tons. With China, 287. So what do we pay attention to figure out what's the reality of the market? I think increasingly folks are looking at the world less China, because we have a hard time figuring out what they have. And if you look at that perspective, then things are pretty tight in the corn market. Well, thank you for the opportunity to speak with you. I'll sure take any questions, or Chad, if you want me just to hold off on them and take them later, we could do that too.
Yeah, we'll figure it out. Again, some good stuff here, Dan. Been throwing a lot of stuff at everyone. Looks like don't have any questions now. I just know for a comment speaking to this, the ending stocks and stocks to use, just, it's just hard not to notice. There's just some usual piles of corn and grain sorghum that I'm used to seeing, well into the spring months at certain locations across the state, and those piles are gone. So sometimes you even wonder. It's tough if you're staying in your local level to even picture where there even are any ending stocks there, and it's really telling when you see that. We're just kind of on this, it's not that linear relation, so just a little bit smaller of a shock in the carryout number could be add a lot more volatility to this market.
Yeah, in this situation, any increased worry about, well, it would be probably for the whole industry a good year to have a good crop without any worries. It would be quite a year if we didn't. It'd be quite a year if we didn't.
Yeah. Did have a question. You have a comment? It's about what our expectations are for distillers grains availability. I think that has a lot to do with how the ethanol plants are running.
Oh, DDGs availability.
Yeah.
I would say I have on a, where I try to go to make sure I'm up to speed on what's happening in the distillers grains is there's a daily ethanol report USDA puts out of the Ag Marketing Service, and I don't know the exact quantities. I think Renewable Fuels Association has something like that, but the prices for distillers grains jumped up the first few weeks up to about $225, $230 per ton, and have been going level since then. So it's strong uptrend about the first 4 or 5 weeks, and then sideways. So that is going sideways says something about whether we have continued worry or not. We've sure priced them higher, but what I wonder on is Iowa ethanol prices also at the same time follow almost the same pattern, jumped up to about $1.50, and they're just hanging there for about the last 3 or 4 weeks. Kansas ethanol prices today anyway, range of 142 to 153, $1.48 average. So following probably a very similar price pattern. Are they going to be available? Well, as I think part of the issue that has gone on, and you need a stocks report to verify this. If the plants are still running, then they've secured supplies. Now they've had to pay something to do it, but if there are, maybe there are reports of slowdowns and delays and whatever, but I have not heard of that very much. And so I'm thinking they've secured their supplies. They aggressively bought, and they're part of that group that hedged, on as we saw in the commercials. And so for old crop, I would hope they would probably, if they've been that proactive and aggressive, I would think I would hope that they would be in good shape through this summer. But and then they're waiting for that next crop. Again, do we have that next crop? We probably will. 8 out of 10 years we do, but that's the risk for them down the road, I guess. So here you asked me a straightforward question. I've talked for 5 minutes and not directly answered it. So other than saying that the market prices haven't kept going up, it must be some indication of some stability.
Yeah, I got it. So that just a couple other questions. You have trend line. David asked, with trend line yields of 176, then does that imply the ending stocks jump over 2.0, I guess, billion bushels in that case? Where are you?
Yeah, I'll go back to, yeah, I used a conservative number, basically leaving in, here I'm going too much. Anyway, I left in that one low year to get the 173. Yeah, if you plug in 176, since 2.5 bushels times the about 1.5, 2.5 bushels more. There we go. So yeah, if you plug in the capacity of the 176.5 instead of 173.4, again, add 3 bushels. Yeah, then both those scenarios look a little bit worse, and that other one would, it takes you down some proportional amount to, is that 350? Is it 340? Something like that, if you get 3 extra bushels per acre nationally in the U.S.
Got it. And then one question here, I know that I get this question a lot, and I'm sure you get it 5 times more than that, but it's just this overall comment of, just it appears, from the outside that USDA has been behind on the numbers, that the ending stocks weren't there all along. And because of that, it caused this, as that kind of gets corrected, we've seen this major jump in grain prices, and a lot of producers, and I'll put myself right in that camp. Didn't, especially with a lot of our old crop, didn't have the bushels to take advantage of this swing. So, do you think markets have recovered from that, or what's your comments on kind of that feeling, that perception out there that the carryout really was never there?
Well, I think that the pattern, and this is just being flat out honest with what has gone on. The last 2 years, the USDA in their September quarterly reports have went back to reconcile what the size of crops were, and they've had for about 2 years running, they've found out that they had 50 or 100 or 80 million bushels too high a number on their production. Now, that said, we're growing a whole bunch of corn all over the place, and the USDA has, because of tightness of money, they're not able to get out and do the infield sampling as aggressively as they were in the past. So, and I think their revealed approach is, first, make sure that they don't cause a great big market panic by a major change. All that said, they've had an issue here of late to where they've had to come in and adjust down the size of their crops, but not by billions of bushels. It's more in the hundreds of millions. Not as big a, well, so I think for them that it merit. I know the person that is the head of that's a Kansas guy, and does, I know him personally, does his best job possible, is very conscientious, but they've just got a great big data aggregation issue that, and it's perhaps perhaps the size of these crops and all the areas and nooks and crannies and corners of the U.S. that they're trying to measure accurately are stressing their system. So I've probably got 3 FSA people or USDA NASS people on this phone call, and I'll probably get angry calls tomorrow. But they've got a tough job, and again, their revealed issue now is that by some amount they've been last 2 or 3 years they've been overestimating the size of the crops.